Okay, good evening everyone, and welcome to tonight's episode of the Irish 30. My name is Una, I work for the Irish Support Agency, and the Irish 30 is a series of webinars, monthly webinars that we run in regards to all facets of wellbeing. We are joined again tonight by the very informative Ciaran Davis as part of the Financial Wellbeing series for part 3, and we are tonight going to be looking at investments and planning for the future. This whole series is designed around just getting money smart and being informed about making financial decisions and knowing how best to sort of be honest with yourself about your current situation and looking to make plans for the future. So just before we get started, I do want to acknowledge that I am hosting this webinar from the lands of the Gweedjil people. I also acknowledge the traditional custodians of the various lands on which you all work today and the Aboriginal and Torres Strait Islander people participating in this webinar. So without further ado, I'm going to hand it over to yourself, Ciaran. And listen, thanks so much again. You've put a lot of effort into the past few presentations. We're very grateful and really looking forward to tonight's presentation. So thank you so much.
Thanks, Una. Right, ladies and gentlemen, so this one is around investments and investment risk, and hopefully if there's any questions, please do stick them up or send them through and we can go through them. There's quite a lot of information tonight, Una, so I'll probably try and be as quick as I can. So why invest? So I suppose a lot of people ask me, why would I bother? You know, I'll just leave my money in the bank. And really I say to them, well, that's probably the worst thing you can do these days. You know, most people want to build a future. They want to buy a home. They want to save for the kids' education, become financially, independent. So returns from cash, as we know, are pretty much non-existent at the moment. So we want to try and make our money work as hard as possible. And the best way to do that is to invest and educate yourself in how to do that. Before you start, I do recommend people maybe go back to the first presentation and have a bit of a chat and have an understanding about what they need to do to get their house in order. Do their cash flow, do their budget, check their debt levels, do some refinancing maybe, make sure to have an emergency fund. Pay yourself first basically means to save once you have your house in order. Know your numbers and understand how much you can put away on a regular basis. It is possible to invest a lump sum or a regular amount, but also get your debts under control. Make sure you're not paying 20% on a credit card and saving to earn 7%. Doesn't make sense to do that. Get your house in order first. I do like everybody to have an emergency fund where if something happens, and we all, again, referring back to the first presentation, if we all had to get home in a hurry or whatever, you need an emergency, it's better off to have a cash account or an offset account if you have a mortgage with some money put aside. In terms of starting as soon as you can, I mean, again, from personal experience, I think the best time to start is always yesterday, because starting is the hardest. And I think the biggest thing here is it's time in the market and the amount of time you have in the market. It's easier to make money over time rather than just, I'll do it tomorrow. So an example here is, you put away $500 a month over 10 years at 5%, you might get back 75,000-ish. This is no reference to taxes or fees. This is just pure numbers. Again, if you did $250 a month, so it's the same amount of money if you look at it over 20 years at the same interest rate. So you're looking at around $99,000 back. So even though you paid $6,000, you're in two different scenarios. There's a big difference in the actual return. And then the example, well, if we added in $10,000 at the beginning, same amount of time, you're looking at 91,000 or 125,000 over 10 or 20 years. Mm-hmm. So the big question or the big takeaway there is start as soon as you can. Doesn't matter how small it is, just start. A little bit here about inflation. Inflation is the one thing that we do need to think about. Growing up as a child, I guess buying a Mars bar back in the 80s cost about 15 pence. Now it's about €1.10 when I was looking and doing some research in euro. And of course, it's got smaller as well. So we all know what inflation is inherently. It's just actually trying to understand it from a dollar or a pound or a euro point of view. One of my favorite memories, and this is going back a while, was when I was in Carlow as a student, and the Guinness had a promotion, and they basically gave us scratch cards. You got three 1920 scratchies, and you came out and you got the price of a pint in 1920, which worked out about a penny. So that was a great example of how inflation worked to my benefit.
Mm-hmm.
But if inflation was running at 2%, and over 10 years, the value of $100 has to actually go up to nearly $122, and that's just at 2% to retain its purchasing power. If inflation is running at 3%, you're looking at $134. And inflation has been very benign over the last 20 years. But with COVID and all the money printing and etc., it is designed, or it's probably likely inflation is going to come back stronger than the last 20 years. And then I'd like people to remember, in places like Argentina and Venezuela, where inflation is a lot higher, it can ruin a whole economy. So some key terms, I'm going to break this down into growth versus defensive. A growth asset is something that will grow over time, including income and capital growth, which is this, hopefully will outpace inflation over the longer term. An example would be shares. So share or equities is a full or part ownership in the business. So that can be on the stock exchange or it could be a private business. It depends. But you can buy and sell that share quite easily and quite effectively on the ASX 200 as an example. And pretty much you can buy and sell shares around the world if you're interested. But not all shares, but most shares will pay a dividend. One of the advantages of dividends in Australia is that they can be franked, which means their taxes are already paid. And depending on your tax rate, you may get some tax back, or you may have to pay a little bit of extra tax on it. But generally speaking, it's a very effective way to save and get an income stream. And remember, inside a super, that's taxed at 15% rather than your marginal tax rate. So looking again at shares, as I said, they can be bought around the world, US, UK, Ireland, big companies, small companies, very, very liquid. And it's really important to invest outside of Australia because Australia is, although it's the 12th largest economy in the world, it only really accounts to about 1.6% of the global economy and about 0.3% of the global population. So there's a big bad world of investing out there. And it's widely available to everybody, whether it's direct shares or indirect shares. And to get the best returns, you're probably better off also investing outside of Australia. So we've had a little bit of a think about what kind of reasons you'd want to invest in Australia, what kind of things affect investing in shares in Australia. But it's generally down to economic conditions, inflation, interest rates, market views, all have bearing on individual shares. The ASX 200 is the biggest 200 shares in Australia, and they're the easiest ones to buy and sell, basically. It's very cost effective. I think it'll cost you around about $20 on average to buy and sell a share. Some common shares in Oz, you're looking at CBA, which is Commonwealth, BHP, TLS, which is Telstra, WOW is Woolworths. And they're all big, common shares that everybody buys on a daily basis. The dividend yield is a way we can look at how much of an income we can get from that share. So a quick example, if the share is worth $20 and you're getting $1 in dividend, then effectively the yield is about 5%. The shares themselves can be bought directly through a share trading account, the likes of Macquarie or even Commonwealth, CommSec, or through a managed fund, exchange traded fund, and of course your super. So plenty of ways to get into the market, plenty of ways to get out of the market. A rule of thumb, a financial planner would normally say it's best to have at least 20 shares in a portfolio. So you're getting a good spread of investments. I think we have some examples of share profiles from Morningstar.
We do. So Ciaran, just before we go to those, can I just ask, so could I tomorrow go and purchase shares or on my own, or would I need to go through a financial planner to do that?
You can absolutely do it on your own. Absolutely, yeah. So you just need to find a way to buy the shares, and obviously you need the cash. So if you go to a share trading platform like ComSec or say Macquarie, or just Google a common one, and you can pay your money across and then buy the share that you want. I mean, I'd caution you and say you need to do some research, and you don't want to be buying a share that's not going to give you a decent return. So
will a platform like ComSec or something like that, what sort of fee will they charge me to do that?
So again, it will vary depending on the platform, but typically $20 to buy the share. But there'll be very, very minimal, if no, cost to hold it there. But again, you need to do your research before you decide who you want to invest with.
Okay.
So yeah, an example here of Telstra. So we use a large research company called Morningstar when we look at individual shares for clients. And the key takeaway here, I guess, is the 4-star rating that you can see at the top of the screen. But we can also get information on the dividend yield and the value and capital growth potential for each individual share. So it tells us a lot of key metrics that we're looking at on a daily basis. I think the next one there, Una. So Commonwealth. So you can see this one is rated as a 3. Generally 5 is the highest that they go. And so not quite as well rated as, say, Telstra. And that'll be down to the value of the share on the day, really, and how the analysts look at it and project forward earnings and capital growth.
So Ciaran, could these change daily, these sort of ratings?
Probably not daily, Una. Analysts will look at things in maybe quarters or half yearly, depending on the size of but they could change monthly.
Okay.
But not really daily.
Okay. Okay.
And then this is just a different one that I picked up because it's got a 5-star rating, A2M milk company. So these ones deal with milk, probably not as well known as the other two. Now these have got a bit of a story behind them in that they sell a lot of milk to China, and the Chinese story at the moment is pretty much anti-Australian. So the share price dropped a lot in the last, say, 6 months to 12. And therefore, the analysts see this as quite a bit of value to be had and capital growth to be got over the next 12 months. So you can see, hence, it's valued as a 5-star. So not a recommendation or anything, but a different kind of a company to the other two.
So if I was to read that document, would I sort of get that understanding sort of said?
Maybe not straight away, Una, but if you did your research and you kind of Googled or researched the key terms inside there, yeah, I think you would. Okay. Anyone who's done a little bit of financial accounting would have the ratios that'd be handy.
Okay.
I've been doing financial accounting ratios since, gosh, 6th year. Wow. Doesn't mean I'm an expert at it or anything, but it gives me a bit of background on it.
Yeah, of course. Okay.
All right, so obviously the next big asset class is property. I guess most people will have an idea of property themselves, but I get it. I meet a lot of people who think property is safer than shares, and potentially it is, but it has the same kind of metrics and risks as maybe shares do. You never put all your eggs in one basket, so you should diversify. Most people buy property and that's it. Think they're done. But if you buy the wrong property, you're going to have the same problems. You have the wrong tenant, you're going to have problems. So it does carry risk. In terms of what you can buy, you can buy full or part. I mean, you can have joint tenants in common. You can buy residential, be commercial. It's a massive investment area in Australia, and particularly residential property, because you can buy it outside of super, but you can also buy it inside super. If you have a business, you could buy a commercial property. You can buy a commercial property if you're ordinary Joe Public, but if you have a business and you buy a property, you can rent that property and take the rent and put it inside your super. So it's quite a useful tool, having a self-managed super fund, if you want to buy property and rent it to your business. Capital values on property can increase, can decrease. Income for rent can increase, can decrease, can even stop if your tenant leaves. It's very common to use negative gearing in Australia, and that's when the expenses to run the property are higher than the income being received from the property. Now, the GFC had a massive impact in the US and also Ireland, I guess. So it became a very illiquid asset. So what I mean illiquid, it means you couldn't actually sell property in some cases, and property funds as well as individual properties, because people walked away from the asset class. So I guess my takeaway there is it's not the be all and end all when it comes to investing.
Mm-hmm.
I put in a little bit here about rental yield, gross yield, net yield, and basically they're just two metrics that look at the return on an individual basis on the property. If you had income of, say, $26,000 in rent, and the value is, $500,000, then straight away, you have a gross yield of about 5.2. The net yield takes into account all the expenses, so you're taking a lot of the income away because you're paying for the expenses. It's a little bit more realistic, and you can see it's 1.2%.
Yeah.
That doesn't take into account the potential growth. So if you were looking at the property was going to grow 3, 4, 5% a year, and your rent grows a little bit, you could find those yields increasing and adding to the value.
Mm-hmm.
Most properties purchased using finance, in fairness. So it's not often that you have enough cash to buy a property. So you're also paying interest costs. Cost to purchase investment properties, self-managed super funds, properties are higher. And I put some examples of costs there. Stamp duty, can't get away without paying stamp duty unless you're a first-time buyer and buying up to a certain value. Conveyancing costs, so legal costs, maintenance and sales. So a lot of costs when you buy property. So it's like a chunky asset.
Mm-hmm.
I did a little bit of an example here of what negative gearing with 100% finance looks like. It is a little bit complicated, I guess, if you're not used to numbers, but I'll run through it quickly, Una. If you buy a property at 700, your initial cost, stamp duty and conveyancing, would be about 30. So your total cost is about 730,000. Rule of thumb, you need a 20% deposit. So that's about 140,000 up front. If you add the costs, the stamp duty and conveyancing, it automatically becomes $170,000. If we were running a loan on the deposit and the costs at 170, that's about 6,800 a year. Plus the loan on the property itself, you're looking at 22,400. So the total interest costs are around about 29,200. But of course, if interest rates go up by just a mere 2% to 6%, your interest goes from 29,200 up to 43,800. So quite a big jump in the cost to run it. Then when we add in our maintenance costs, you're looking at a shortfall of around about $11,000 a year, which is the tax deduction that can be added to your tax return, depending on if it's a joint ownership or whatever. And that's why a lot of Australia is gearing. Any questions on that, Una?
Yeah, well, I suppose we did have a chat before this about this whole negative gearing thing, and it's I think it's quite interesting that that is how Australia is geared, and we sort of tossed up ideas as to why that might be. In terms of property and having property as an investment, do you think that the appeal of property is because it's a very tangible thing for people, regardless of the costs that can build up, and let's face it, the hassle involved in purchasing property, but because it is that tangible asset, that there's maybe people have a bigger sense of security with it? Or
Yeah, I think you're right. I think definitely people like to think that they've got bricks and something that they can. It's a bit of an ego thing as well. People talk about the property or my investment property much more than they will about their share portfolio. It sounds better. So there's a mix of things there, and it's easier to understand as well, I think, because most people, people live in property. They understand the value, their neighbors value property and their value and what the differences are. So it's a very, I suppose, common discussion point. Most people can't touch shares. You get a statement with a share on it. It doesn't mean the same as a property that, as I say, that can drive by. Doesn't mean that buying property in your neighborhood is a good idea, because you should still really diversify. You should move out and have different sections of people buying your property or renting your property. So just because you live in a good street doesn't necessarily mean you should have a property in that street.
Yeah. Would you advise anyone looking at purchasing an investment property to truly fully understand as to whether it's something they can afford or not? Because I know that we spoke obviously about the financial crisis in Ireland and the disaster with sort of the property market there, and there was a lot of people who went into that on poor advice and misguidance from different sorts of people. So would you advise anyone considering purchasing an investment property to seek advice as opposed to going it on their own?
I would, because purely because in the middle of this page you see the difference there between the interest rate at 4% and then with an increase at 2%.
Yeah.
How that extra would impact the day-to-day,
yes,
year-to-year expenses, because
yes,
what happens if interest rates go up? What happens if the tenant leaves? What happens if he wrecks the joint? We do cash flows. I will never tell a person to buy or not buy a particular property, because I wouldn't have the expertise to say, but I can tell them about the impact on their own individual situation.
Yes. Yeah. Okay. All right. Here's some things to note anyway.
Yeah, I think the main one here is it's not good practice to buy an investment just because you're making a tax haven. You want to have an investment that stacks up on its own legs, that is there to pay a reasonable income but has the potential to grow. I haven't been in Australia that long, but I've met plenty of people who bought in certain areas thinking that, well, it's I'm going to make a tax haven, and then this area, whether it be regional or urban, will grow over time, and it hasn't done it. So for every good story, there's an equal bad story. So just make sure the investment stacks up before you start getting happy about the tax haven. Because there are other tax advantages. New build in particular, you get the depreciation on the fixtures and fittings. But again, it comes with a lot of risk if the values don't stack up when it comes to settlement. Does the client have the money available to pay the shortfall from what the bank is willing to lend?
Yes.
It's always a good idea to seek advice. Always a good idea to check your cash flow, and anything with particularly 100% gearing is a very high risk strategy. So tread carefully, buyer beware. Self-managed super funds, I've stuck in that there because purely it's the best way to buy property with your super. It's the only way to buy it with super, other than an indirect property investment. I wouldn't personally have a self-managed super fund unless I was buying property, be it commercial or residential, because it's a very costly exercise. There's apart from the costs we mentioned before, you have to have an accountant, you have to have an audit every year. But I know a lot of people who've made a lot of money putting property inside of super. So you can also have your shares, but you can have real estate investment trusts, which is property, but be it indirect. So you're not going to drive by it, but it's still exposed to property. All right, so on the other side of the fence, we have defensive assets. So these are considered stable, more cautious. Doesn't mean they're 100% guaranteed or anything like that, but they're generally over time more cautious than growth assets. So typically you're looking at fixed interest and cash. Fixed interest is basically a form of debt. It's money that's owed from one to another. You have a guaranteed, you're supposed to have a guaranteed return, guaranteed income stream for a certain period of time. I often explain this with government bonds as one or two of the main ways that they can raise money is by taxing you and me, or they can raise finance through the bond markets, the fixed interest markets. So if they want to build a road, they want to build a hospital, you can either raise general taxation, or you can go to the debt market and say, we need $1 billion to build this hospital. What will you give us?
Okay.
The main thing it comes down to with bonds is how well the rating is of the person selling the bond. So a lot of companies, a lot of governments are all rated by the agencies, the likes of Morningstar, and they range from AAA all the way down to junk bonds. And the lower the rating, the higher the interest rate. So if you think about interest rate as the risk on the investment, the higher the interest rate, the higher the risk. Yeah. Australia, this is why I guess you hear Scott Morrison saying we've got to protect our AAA rating. The AAA rating means they don't get charged as much interest when they go to the markets looking for money. Cash pays interest, hopefully, not always. Can increase, decrease. We are, no two ways about it. We're getting the lowest returns on cash ever. There's no capital growth. It's just the interest that you can get back. Cash has other value other than interest, though. It's there as an emergency. It's there for liquidity and also opportunity. If you see an investment that you think is great value, you can buy it when values are low. So it's always good to have some cash available. Alternative assets. So you're looking at hard and soft commodities. So that when I mean hard and soft commodities, I mean the likes of coal, iron. Soft commodities is agricultural, and you can buy and you can invest into these assets if you want to as well. Back in 2005, I put a lot of money into BlackRock Global Resources. That made a lot of money for people, and we could be back at the start of this commodity cycle again because of a lot of the money printing that's happened because of COVID. Gold and silver is very popular, and Bitcoin, of course, is really, really popular now. Most planners wouldn't get involved with that because it's such a new asset, and there isn't got that same historical data that the other assets do.
Would the market for commodities be? It wouldn't be a strong performer in terms of investments, would it?
It can be, but it goes in cycles. So if you get in early at the early part of the cycle, you can make a lot of money. But then it tends to have long periods of time, like 10 years, where it won't do very much. It's all about supply and demand. Okay. So when supply is low, demand goes up, the prices go up, so you can make some money. And then capacity catches up and supply catches up, and then the prices generally stagnate or fall. Okay. Just a little bit about buying physical coins, physical gold from Perth Mint, or mining shares, managed funds, exchange traded funds. So if you're the type of person that likes gold, it's also an available investment. Okay.
So, Ciaran, just as sort of you made the point there that cash is earning the lowest interest that it has been for some time, and traditionally, if that's how people sort of kept their money and saved their money and hoped that it would earn them a bit of interest for later in life, they sort of would have maybe only relied on that. So at the sort of the point of time that we're at, where it is at an all-time low, if anyone wanted to very sort of, dip their toe very slightly in terms of making that money work a little bit harder for them, where would you suggest might be just a good sort of initial place to start if they were, just very new to this area?
So in terms of investing, or in terms of cash, Una?
In terms of investing.
In terms of investing, yeah. I'd probably try and find a decent book to read about investing, and I can send some, decent recommendations after if you want.
Yeah.
Read about how the markets work, get familiar with some of the key terms.
Yeah.
I'm very happy to help out there if people have questions for me afterwards. Maybe start reading the financial sections of the papers and looking at picking a share, maybe even going on to a platform and picking some shares and put them on a watch list and see how they rise and fall over time. That's for free, doesn't cost you a penny.
Yeah.
And I think the more you read, the more you'll get familiar with things, and then over time you'll get familiar with a share, and you'll say, well, I like this because, and some of the really good investors like Warren Buffett, they release information now and again about how they see the world economy going and how they see their own investment vehicles going. And just read that and, get advice.
Yeah. Okay. Fab. Okay. So moving on.
There's a very good question come in there, Una. Can you see that? Ethical investing?
Yeah.
So I didn't include anything about ethical investing actually, because it is a massive area, and I actually joined my first insurance company back in 1999 called Friends Provident, and they had the first UK ethical investment called Stewardship, which set up in 1984, and it's a massive area, and a very worthwhile area looking at. You just have to be very careful about what you mean by ethical investing, because there's lots of different definitions. You can have pure green investments, which won't touch, all of the oil, the tobacco, the porn industry, that sort of stuff. But you can also have lots of different colors of green up to light green, where they just encourage the investment committee or the board to think about certain things. So there's no real framework in Australia that delineates all those definitions. So you'd have to have a very good conversation with either the investment house that you're going with or the financial planner that you've chosen to determine what you like and what you don't like. Okay. So, but a massive area. And there's some supers in Australia that do purely ethical investing as well, and some really good ones.
Great. Okay, so maybe you can give some recommendations maybe later on.
Okay, so in terms of risk associated with investment, so I guess the key thing here, without going into every line, is people suffer a loss twice as much as a gain. So if you look at lots of behavioral studies, financial studies done where people are investing 100,000, and the 100,000 might grow to 150 and they feel good, but then the 100,000 might drop down to 80,000, which feels absolutely twice as bad as making that 50. Yeah. So people regret that loss more than they do the gain. So this is why it's you have to be, I don't do any short-term trading. I'm not buying and selling in a day. I'm working on people's medium and long-term objectives, and I make them all aware that there's no guarantees in this game. You can make a lot of money and you can lose a lot of money. It's all about timing, and anybody who buys at the top of a market and then sells at the bottom of the market is guaranteed to make a loss. The best thing you can do is wait for your money to come back. But the various risks there that, it's nothing too exciting, capital market, inflation, etc. I'll let people read through that themselves, and of course, if they have any questions, they can come back.
Sure.
This one is a good one, Una, in that it's I guess the one thing people don't think about is, well, what happens if I don't hit my goal?
Yes.
I need to raise going to invest 800,000, or I need 800,000 in 10 years' time. It's a rock solid goal. But what happens if I only get 600,000? How do I get that shortfall? What's going to happen there? So it's the adjusting of the goal, or it's the adjusting of the risk profile. Something has to change. And financial planners' job is to educate people in that regard. What can move in the equation to help you meet your goal? I think we have another graph there.
Yeah.
There we go. So this is the relationship between risk and return. And you can see there that cash is low risk, but it's low return. Then we have fixed interest, which is what we mentioned earlier, the bonds, property, Australian shares, and international shares. And there's lots of other layers in between when you move up along that scale, but broadly speaking, that's the main asset classes that we're looking at. And then we have diversification, and a little bit of an explanation about what diversification is. Basically, it's spreading your money between those asset classes.
Yes.
And again, here we're getting a bit of a, when we build our portfolios and we have defensive, conservative, all the way to high growth, the return is getting steadily higher, but also the risk is getting a lot higher too.
Yeah.
I guess the misconception people have is, I want the highest return and the lowest risk. That can't happen. You can't have a 10% plus return and a cash-like risk. It's a mixture. It's all about the education piece. If you want 10% plus, you're going to have a higher appetite for risk.
Okay.
If you want, sorry, you want to go?
No, go on. Yeah.
I was just saying, if you want cash-like risk, you need to have lower expectation on your returns.
So in terms of then, I think it's a very important point that risk is very personal to everyone. It's very unique.
That's a very good point.
A set of circumstances. So the idea is figuring out where exactly your personal feelings lie amongst that sort of graph, and being very realistic, about the risks that you're willing to take, and accepting, okay, what can I accept to lose if I do lose?
Yeah, that's a really good point, Una. And time generally heals all wounds, and it's the same when it comes to the investment markets. If you have the time, it'll come back. But if you have a very short time frame and you have invested and the market's dropped 20%, maybe you shouldn't have been in that investment in the first place.
Yeah. Ciaran, we have a question here. How does the time frame influence which asset class we should consider investing in?
Yeah, so good question. Short term, and I'm talking about probably a year or two, you shouldn't really be in. The majority of your money should not be in shares, growth assets. So if you were saving for a wedding, or you're saving for a house, and I know plenty of people who will stick their money in the market, but it wouldn't be something that I would ever advocate if I needed that money back within a year or two. So short term, you're looking at cash and potentially some in fixed interest. Longer term, 3 years plus, that's when you can start adding in some equities, and volatility is the different rates of return and expectations on your money. Certainly, when you look at 7 years, 10 years plus, then that's when you can put the majority of your money into growth assets.
Okay. So then in terms of then, I think we have a bit on diversification, but it's sort of trying to mitigate some of the risks associated with the different options.
Correct. It's not meant to give you or boost returns in any way. It's meant to reduce the volatility, reduce that kind of roller coaster ride in your portfolio.
Yes.
Because everybody could be 100% in shares if they had over the long term, but it'll be a very interesting experience when the markets go up and down 20, 30%. And we've got a graph later on, which we'll refer to, which shows all the different things that's happened in the last 20 plus years. And it's amazing the amount of increases and decreases in the market. So again, diversification. Do we have another graph there? Risk profiles and strategic asset allocation.
So I think we were going to look at the Schroeder one.
Oh, we were. Yes, we were. Yep. So I'll come back to that question about the time of it, because it's a really good one. But this one is one of my favorite ones, to be honest. This is the individual asset return over the last, say, 20 something years, I think. Yeah, since 2000. So the very top return here in 2000 was AREIT. So that's Australian Real Estate Investment Trust, basically a portfolio of property. And then we have Australian fixed interest. So Australian fixed interest being government or corporate bonds. Then we have Australian credit, which is fixed interest, international fixed interest, Australian equities, cash, 6%. Way back 20 years ago, cash was giving you 6%. I know. And then the worst performing asset was emerging market equities. And then if we run along the very top there, you can see AREITs did 1, 2, 3, 4, 5, 6, 7, 8 best years. But guaranteed down at the bottom, you can see 2007, 2008. Were also 2 worst years.
Oh, yeah.
So there's no rhyme or reason. I sometimes try and catch my clients out and say, what's the pattern here? Show me where you should be in advance, pick the winner. And nobody can pick a winner because there is no pattern. But looking at this, it shows that we should have portfolios. We shouldn't ever put all our money in one asset class. We should spread our money so we can get a mix of those returns year on year. Because if anybody's able to pick that winner year on year, they're not going to need a financial planner. That's for sure.
So yeah, it's very interesting to see how it has changed. I'm quite surprised at how high the fixed interests were. Yeah, and now.
Remember, it's not a guaranteed return with fixed interest. It's not a guarantee. It's not supposed to be a proxy for cash or anything. It's got its own risks associated with it, depending on economic conditions, inflation, interest rates, and you can buy and sell those assets daily as well. It's actually a bigger market than the share market, the fixed interest market.
Oh, really? Okay.
Oh, yeah.
Well, it's interesting to see the AREITs down here in 2008 minus 55%.
I know.
That was sort of like the height of the GFC.
Yeah.
Didn't think Australia had been that hit by it property.
Yeah. Well, if you imagine if you had invested in 2006, say, and earned 33% on your money, you're thinking this is great. I'll put more money in. 2 years later, you would have lost half of it.
Yes.
So you have to be very careful, and you should not be running after winners all the time, because over time those winners will become losers.
Absolutely. Great resource, that, Ciaran. So let's, we were going to look at the risk profiles and strategic applications.
So using that information from say Schroders is one of the reasons that we look at building portfolios for clients. So you can see, going back to my reference about time frame, up to say 2 years, and we color code these things. We say the majority of your money, really 85% of your money, should be in defensive assets. Small, a little bit there, say 15% to try and beat inflation. And then we build them depending on the time frame. So you can see up to 9 years, you can have 90% of your money invested in growth assets.
Yeah.
And then if you pull your way down, if you look further down, you can see the different asset allocations, be it Australian shares, international, etc., etc. And most financial planners would work like that to try and reduce the volatility or the risk in a person's portfolio.
Absolutely. Okay, great.
So I think we've pretty much covered diversification, but it's a way of smoothing out the returns over time. Here we're looking at gearing and leverage, and again, it's basically borrowing to invest, buying an asset class, using borrowed money. And banks will lend a certain percentage of the asset that you want to buy. Of course, you know, 100% finance on property generally won't be allowed when it comes to buying shares with 100%, unless you take out 100% of the money from equity in your property. But even then, the bank could be quite reluctant to give you 100% just to buy shares. So most times you should be really adding a bit of money in yourself if you can afford it. A little bit of an explanation of a positive gearing, negative gearing, and then we've added in what happens when investment markets fall, because, you know, at the moment the share market has been doing well since COVID, about a year ago. Some of my clients' portfolios are up 20, 30%, but they're coming from a very low base in March, 2020. And I guess you have to take the rough with the smooth when it comes to investing, and not to get scared out of the market when the market falls. And then if we look at the Vanguard visual.
Sorry, Ciaran, just to clarify something, you can't borrow money to invest in shares.
Oh, you can, yeah. Based
on what? Like what do the banks have as their sort of their?
So there's two main ways. So if you have equity in your property, and you were happy to take that equity out, you could take 50, 100,000, whatever it is, and then invest it in the stock market. Personally, I think it's a good idea to add some of your savings into that as well. The beauty of doing it that way too is that interest that you're paying on that investment loan is tax deductible. But of course, the downside is that money is borrowed on your home.
Yes.
So if you're unlucky, let's say it's 100,000 that you invested and the market drops 20, 50%, all of a sudden your loan is more than the equity value.
Yes.
So you're back to that negative equity scenario, or negative gearing scenario even. Alternatively, you can do something like margin lending, which is where you have a portfolio of shares, or you buy a portfolio of shares and you borrow on that share portfolio as well. So example, you have 50,000 in shares, you borrow another 50,000, and now your loan to value is 50%. But you've got $100,000 in shares and you got a $50,000 loan. You can go up a bit higher than that, but if the share portfolio drops in value, the bank will make you sell some of those shares.
Okay.
It's also at a higher interest rate.
Okay.
I've seen them up to like 8%. So your money has to work hard for you to get up to that 8%, obviously. So it's not for the faint-hearted, and you wouldn't want to have too much money in cash or fixed interest in those portfolios. You'd want to be thinking that you're an adventurous investor.
Yeah.
Does that make sense?
Yeah, it makes sense. It just seems quite risky to borrow money off invested money that is volatile, but
yeah, again, it's a long-term strategy, and it's not something really you want to be doing for 2 or 3 years.
Yeah.
But again, if you believe in that compounding over time, and you have to be active in it. You don't want to be just taking the good with, just letting
Yeah.
it run. You want to be thinking about
Okay.
it. Yeah, so this is another favorite of mine. It just shows you the highs and lows of investing over the last 20 years or so. 30 years, yeah. So I haven't been investing that long, but I started working as a planner in 99 and started working in finance in 97. So I kind of do remember a lot of this stuff. And there has been an awful lot of movement in the stock markets. So if you like financial history and economics and politics, everything that's happened over the last 30 years is in this graph.
Wow.
Yeah.
So,
the key point is, if you're investing at the bottom of the market, not that you know it at the time, you'll make money. If you're investing at the top of the market, not that you know it at the time, you need to hold on until your money comes back before you sell. If you guaranteed to lose money when you buy at the top and sell at the bottom.
well, I think it was I remember when we first looked at this and you sort of highlighted all of the sort of the global
Yes.
events that have happened across the 30 years, and yet you still end up, in a good position. It's a good visual, I think, to show
Yeah.
that.
Now, that's not to say, if in certain key parts of your life cycle, like you're moving to retirement, or you're reaching the end of your savings goal, you probably want to be actively looking at, well, what do I do with this money now, just in case something like one of these big drop happens.
Yes.
How do I protect my money? How do I take some profit off the table?
Yeah, you wouldn't want to be at this point, if you're just going into your retirement sort of.
Yeah.
You still want to have time to allow your money to work for you and to.
Absolutely.
Yeah. Okay.
So summary, never too late to start. Let the magic of compounding do its work. Know your numbers. Invest in research. Invest in yourself and do some research. Have a plan and don't panic when the markets drop, because guaranteed they will drop at some point. Diversify. Spread your money. Don't have all your eggs in one basket. And I guess if you're unsure, have a chat with a professional.
Okay, well, listen, thank you so much. That was eye-opening for myself, I know, and I learned a lot through it. I suppose, just coming back to that point that, look, investment, it may not be for everybody. It's important just to identify exactly where you are financially in life, and whether it's going to be suitable for you, taking into consideration the amount of time you had. There's certainly no sort of get-rich-quick schemes out there. It wouldn't appear to be, and it is what I've learned, certainly throughout all of the presentations. It's all about longevity and starting as early as you can, and just being as informed and educated, regardless of whether you want to put anything into action. Just knowing about all of this, giving people more power, and in terms of their financial status and well-being. So look, would like to open the floor up to anyone who might have any questions. Feel free to pop your mics on and join in the conversation. I see another question coming here. To get started, how much would a financial planner expect you to invest over what period of time?
So that's from Gary. It's a good question. I personally, if I had $2,500 and I was interested in it, I'd be getting in. I'm not sure, there's that much help a financial planner can help you with that kind of money. But my initial consultations are always free, so we can always have a chat about where you should go looking product-wise or investment-wise. it's a little bit easier when you have around about $10,000 because of the platform fees, the costs that are associated with it. But certainly there are places you can go with $2,500. It's just whether or not it's worth your while, doing that.
Because of fees.
Mainly because of the fees, yeah.
Okay, yeah. I suppose they want to make it worth their while, so they want to. The hosts of the platforms.
Some of the platforms expect you to have a certain amount in cash. So, but there are some product providers out there that'll just allow you to put $2,500 in. I'm just, in terms of, it's going to take a long time for that money to grow, and there's a point there Gary made about the time frame influence. I'm hoping the asset class, the different portfolios that we showed, answer that question for him. Mainly around the 2 to 3 years being cash and fixed interest, and anything after that you're adding in your shares.
Well, look, as always, Ciaran, you are available for follow-up questions from anyone. The presentation will be made available to everyone, and if anyone needs any further information, I mean, it's such a huge topic, we've just sort of skimmed the surface on it, I believe, Ciaran. So if anyone would like to post any follow-up questions, Ciaran has said that he'd be happy to do so. So yeah, so feel free to send those to myself. I can provide my contact details. So unless, does anyone have any other questions? I know it's a big topic and there's a lot of information in that presentation. So it might be a case of people going away and digesting it all. But look, Ciaran, it's been a fantastic three sessions you've done with us. A huge amount of work goes into those, I know that, and information has been invaluable, and it really is just trying to empower people through education now. And we had a chat beforehand, and it started in schools, or get that information to people earlier. I mean, it's so valuable, and can have such a huge impact on people's lives, being financially safe, and not having to have that stress over you. So look, thank you so much. I think you are going to do another session for us in a few months' time down the road, so we'll give you a bit of a break. But look, thank you so much, and thank you to everyone for joining us. The recording will be put up on the website over the next couple of days if anyone wants to go back and re-watch it. So yeah, thank you everyone, and all the best and good night.
Thank you, Anna.
Thanks, guys.